Hi, today we're going to talk about professional corporations. Professional corporations are simply a subset of all of the Canadian-controlled private corporation tax rules that we've recently discussed in our Tax Alpha series under income splitting. You may want to refer back for a refresher. But essentially, Canadian-controlled private corporations receive two tax gifts from CRA. Tax-deferred advantage on low corporate tax rates versus high personal rates for after-tax profits that are retained inside a corporation. This becomes an interest-free loan on money that's retained in that corporation. And then income splitting. To valid shareholders, we are allowed to allocate income to lower the taxes on the income that a family needs on an annual basis to live. Professional corporations are normally the incorporated practices of accountants, lawyers, doctors, dentists, pharmacists, etc. In order to provide the most flexible, tax-efficient structure, a Canadian-controlled private corporation normally has a family trust that holds most, if not all, of the common voting stock of the operating company. This allows for the direct income splitting to the beneficiaries of the trust, as well as the ability to multiply the lifetime small business capital gains deduction of $750,000 in 2013, going to $800,000 in 2014. And this latter benefit is only available if the shares are sold by the family trust. The corporation normally also has a holding or investment corporation, which is the beneficiary of the family trust. This allows funds retained in the Canadian-controlled private corporation, taking advantage of the deferral, to be moved tax-deferred away from the liability of the OpCo. Income splitting may also be done from the HoldCo to family shareholders in the income splitting processes we've recently spoken of. Many owner-managers are concerned that this takes the control away from them with this complex structure, but rest assured it does not. The owner-manager is usually the trustee of the family trust and holds all of the voting common shares of the HoldCo. Professionals normally must obtain the permission of their provincial legislative bodies. For example, the CA Association of Alberta, the Upper Canada Law Society of Ontario, in order to incorporate legally under their mandates. These professional bodies will limit how the professional may hold the shares of their professional corps in order to ensure that only professionals own and control these professional corporations. This limitation in many provinces explicitly excludes the use of a trust or a HoldCo or any corporation as a shareholder in the professional corp. This will eliminate the tax planning techniques that we just spoke of. So it is much more difficult for a professional to do the types of tax planning that other types of professionals in this country can do if they are allowed to have the structure that they require. Each province is different, and you must be certain to be able to comply with each province's regulatory bodies. So how can NexGen help? Well, our corporate class mutual fund structure makes every investment decision two, not one decisions. You pick the fund from our lineup that most closely resembles your personal risk tolerance, and then from our tax classes, you pick your tax objective. For example, a professional corp has to hold its investment money in the operating company. It wants to avoid, if possible, the high passive tax rates on investment income earned in that professional corp. These can range anywhere from 43% to 50% depending on the province in question. NexGen's compound growth tax class intends to provide deferral annually, which will allow this growth of your investment dollars to be taxed eventually when redeemed as a capital gain, which is of course a favorable tax rate. So with NexGen, you get your risk tolerance and your tax treatment, and you get them both at the same time. Hope this helps, and we'll see you the next time.